morning, everyone. Yeah, so trading dawn has, it's shifting to the morning, to these morning hours, and we're going to be looking at so many parts of the financial markets. We've been doing a lot of Forex trading, concentrating on the currencies, and so we're going to be looking at some stock markets. We're going to be looking at the African stock markets, the USE, that is the Uganda Stock Exchange, our very own stock market. We'll be looking at Kenya, we'll be looking at South Africa, Ghana, then the French-speaking West African countries, and then the countries at in the far west to that coastline. So it's going to be, it's going to have a lot of information, and you can buy stock from literally any country. You can buy stock if you have money. The stock exchanges welcome money from anywhere. So if you have money and you want to buy stock, and there is a certain exchange in the continent that is performing very well, then you can go ahead and invest. So I'll be providing you with a lot of information that will help you to decide on which market you want to get into, whichever stock market you want to get into, whatever company you want to invest in. If you have to buy stock for a particular company, you can look at how much their payout is in dividends. That is one factor. Two, you can look at the volatility of that company, and you see if you can buy low and sell high, or if you can sell your stock high, then you buy more stock when it goes low so that you earn more dividends. You can do that as well. We shall be looking at bills and bonds, treasury bills and treasury bonds, mainly here for Uganda. We shall be looking at our rates here for the Bank of Uganda, which I think are most likely the highest rates in the whole world. So here our bonds are really, really good for if you're going to invest in them. You can probably make 15% at the end of the year, or 12%, depending on how you negotiate, and depending on also how much you're going to issue them out for. So you can make money like that. So we shall be looking at bonds for other countries, Kenya, Tanzania, Rwanda, Congo, if they have bonds. Okay, so many other countries. So you'll be able to make a decision on which bonds you want to buy. Maybe South African bonds, bonds of Ghana, Nigeria. Those are some rich African countries, especially Nigeria. It's very, very rich. They have too much oil. That also brings us to the commodity markets. Oil, gold, silver. We've been looking at gold a lot, and silver, palladium, platinum. But oil, we've been looking at crude oil so much. Oil only has a certain price in dollars. But investing in oil in other countries, like our African countries, that could be somehow tough. It has to be a real physical investment, not like these online markets. But anyway, that oil affects certain companies that you can invest in and buy their shares, or buy or trade their stock, and you can make a profit like that. Then these days you can also buy international stock. You can trade and buy international stock. It's becoming very easy for so many African countries to purchase international stock. So that is another field we shall be looking at. Looking at Microsoft, Amazon, Tesla, and all those companies. Now those ones there have some good volatility, so you can make some good money while buying their stock. Now for those ones, you might not necessarily earn dividends, but you can trade in the CFD style. You can trade them as using the contract for difference, that style. So you can make money based on the change in price. If the price of a certain stock out there, if the price per share is about maybe $3, $3.5, and you buy and put there, you risk a certain amount of money, maybe $1,000 or whatever. Then the following day it's at about 6 point something. Then you have a very big increment. And another thing you should have in mind is the world has advanced so much. So there's leverage. You can apply leverage to your trades. So if you're going to trade like how you would normally trade here, you buy shares worth 2,000 shillings. Okay, that is too small. Maybe shares worth 100K. Yeah, and then when that share price goes up a bit, you'll probably make maybe 5K on your 100K, maybe 10K on your 100K, maybe in a year. Yeah, so that is trading without leverage, because the more the price changes, the more you earn, or the more you lose. So that can happen. But that is trading without any leverage. Now, with leverage, you can actually make more money. For example, if you apply a leverage of 2 to your account, so the normal leverage is 1 to 1. So there, if you put 100,000 on a certain stock, where the price is 100 shillings per share, and you put 100,000, so when that price moves up to maybe 150 shillings, you're going to have 150,000, because that stock price moved up 50%. So on your 100,000 shillings that you invested, you're going to make 50%, because the price per share moved up 50%. Yeah, so that is trading with normal leverage. That is 1 to 1. That's the ratio of 1 to 1. Now, with the ratio of 1 to 2, when the stock price moves up 50%, your balance moves up 100%, because now the 2 stands for the percentage increase in the stock price. So 1 to 2, you'll be earning twice what you invested. So that gives you more leverage. If your leverage is 1 to 10, you can do the math. If the price goes up by 50%, instead of making 50,000 shillings, you'll be making 500,000 shillings on that. So that is how leverage is going to help you. If it's 1 to 1,000, then you can also calculate that. You put 100,000 shillings when the stock was 100 shillings, and that stock price goes up 50% to 150. The person who will get 50,000 will be the one with a price of, with a leverage of 1 to 1. Then you, with a leverage of 1 to 1,000, you'll be adding, that will be 50,000 plus another 1,000. That will be 50 million. So, you'll be making, a very big increment on your investment. And with CFDs, the opposite is also true. So if it goes against you by 1,000 points, then you're done. You'll be done before you even, you might even start owing the broker some money, because you lost so much that the broker had to lend you money to get into some negatives. So leverage works like that. So with international stock markets, you can apply leverage. It's there. Our local markets, we're still earning dividends. The CFD is not yet there. Most African markets are actually like that. So you realize that most of these companies you're going to be investing in, they'll be for the super rich. They'll be for the super rich. But there are many ways you can benefit from that. One is by forming associations, and you bring money together. Then you become a super rich association, and you put that money into stock. Then when you earn a 10%, if you are just alone and you are putting, maybe, these days they even encourage people to invest as low as 100,000, 50,000. You end up earning 5K at the end of the year. Just 5K, which is doesn't really work. But if you come together as an association, if you're a class, maybe a class studying business, something at university, or studying economics, doesn't really matter what you're studying. You might even be studying botany, or you might even be cutting people and doing autopsies and all that stuff. You can still come together and you put some money, and together you will have a very big portfolio, and you'll be getting some good money from your percentages every year. So some companies pay more in dividends than others. So that is another thing you need to watch out for. And so we're going to be looking at all that. There are so many dynamics in there. I'll be having some people here to explain things further, especially people who are very, very deeply involved in Ugandan stock markets. Those people will be explaining to you exactly how things are done and how you can benefit, how you can invest. They'll be giving you advice on how beneficial these markets can be to you. How much money you can make, maybe 10 years down the road, 12 years down the road. So Yeah, one thing you should know is that these stock companies, they normally exist, and this one is a fact. They exist because of peace in a country. When a country goes to war, these stock markets, they collapse very, very fast. So that is one thing you need to keep at the back of your mind. So you can invest in this stock for more than 20 years, and you can make your money. But if that company collapses in war, all your money goes with it. If you invested in a certain company here, and tomorrow, it just disappears, or if the country goes into war and people start running around, and all that stuff, then, your money goes, just goes into the air. But if you invest in treasury bonds, especially with these national banks, then, that one you can be very, very confident that if something bad happens in a country, when it recovers, you can get your money back with full benefits. That is very, very possible, because the government can do that. So if it's but if it's with these companies, then you have to be very careful. That's why you find many countries, when it comes to politics, they are very serious with their politics. They don't play around because they have a lot of money invested in the day-to-day operations of all these companies. So they want to protect the companies, you protect your investment. Yeah, there's a friend of mine who invested money with a Forex trader, and this man fell sick. He fell very sick, and the clients treated him. He had COVID. So the clients treated him so that he doesn't die. If this guy dies and he's managing your accounts, all your money goes with him. So they got a nice doctor who has nice premises. Nice bed with DSTV, and they took care of the guy so that they would get their money at the end of the day. So that's how we shall treat our politics, so that we make sure our politics doesn't move into these sour zones. So if we invest in all of these companies, then we have a stake in the day-to-day operations of all these companies. So we have to make sure they do not collapse. We make sure the economy does not collapse by any means necessary. So we keep it afloat, even if it means getting into politics. And you'll be there because you've invested too much money in stocks, you've put too much money in all these companies. So you go into politics because you don't want the country to go berserk, because you're going to lose a lot of money. So that's what normally happens. That's why you find too many people who invest too much money in stocks are getting into politics. They want to become big figures, they want to become president and whatever, because they've put a lot of money. They don't want the country to fall apart, because they'll be losing their investments. So that is that's something you should know about stocks. They work where there is stability in a country. That same thing happens with Forex. Forex is very, very sensitive, more than stock. So with Forex, a country must really be, in order to participate in the Forex market, you must really be steady. You cannot be, you can't be having, funny things happening in your country and you're part of the Forex market. It can't happen. Because there will be a lot of money laundering, there will be a lot of drug money, money from lords of warlords, whatever, all that stuff. And that money is not part of a normal economy. So it brings some imbalance into the market. So countries that are facing such uncertainties are not allowed to participate in the Forex market. So if you have an exchange rate, that means that you're stable. Your country is very, very stable. If your money can be exchanged, if it is accepted to be exchanged with another currency of another country or with any other currency, then that is a very stable country. Those that are not stable, you can look for them and you will see that you cannot exchange their money anywhere. It has no value. It only works in their country. So that is something you need to know about the Forex market. If you look at the history of how these markets evolved, it started in 1602 with the Dutch East Indian Company, going way back to how these things actually began. So this was a shipping company. They were shipping all sorts of things, rice, spices from China, from the east to the west, wherever. Yeah, they're also shipping slaves. That was, shipping slaves was really a main business that time. So this company became very, very rich, and people wanted to own a piece of it, and they wanted so many investors. So instead of bringing people together and building boats and more ships and all that stuff, building guns to fight pirates and whatever, they decided to sell shares. Some brilliant person came up with an idea that instead of selling pieces of this company to people physically, let's just create some kind of understanding that this company is now divided into 1 billion shares, and if you want to own a piece of it, you come and buy a share, and depending on how much shares you own, that will be the piece of the company. So the company makes a profit, we shall divide the profit amongst all these shares, and you'll make your money like that. So those are the first people to have to sell shares, that Dutch East Indian company. So they're the first people to sell those shares, and it became a revolution of sorts, a financial revolution. Many companies started doing the same thing, selling shares, and I have shares. You also, whatever company you have, you also split it into shares and then you sell them. So places where, so in order to buy these shares, you'd have to go to that company, you to go to their premises, you purchase, they give you a certificate that you're now a shareholder. Then on their profits, you go there and claim your profits in dividends or whatever they call them. So it was quite a process, but it was limited to people who were, who could travel there. And those days there were no cars, so you'd have to travel by horse or by whatever. And if it's a long distance, it would really be long. So you need to buy shares from a company that was near you. But some other people saw an opportunity. People who didn't have companies to dish out shares, they formed their own company that bought shares from all others, and you would go to them and they would have a variety of shares. Like if me, I go and buy shares from more than 9 companies in Uganda that are selling shares, then I'll be having shares from 9 companies, and you will come to me to buy from whatever company you want, and I'll sell to you part of my shares. And so that company became a stock exchange, because they had so much stock. You'd go there and it was basically exchanging. You go and tell someone, I don't want shares of company A, I want those of company B. I want to give you back all the shares of company A, and instead you give me shares of company B, because I hear it's more profitable. So that's how the revolution started. Then many people started picking up on that. So many people in other countries started picking up on that. In Europe, they started. In America, they also began. And then evolution took place, and other scientists started making other inventions, and then the telephone came about. So now you could buy shares over the telephone. So before you had to travel to buy shares, but now you could just call and buy shares. So that became sort of an electronic kind of way of trading in these shares. And that became popular with the NASDAQ. That's how it became very, very strong. From way back, the NASDAQ has been a very powerful organization. So so they became very, very rich by doing things in that speed, electronic transfer and electronic ordering of shares, and even opening positions. So that became very popular. Then with the coming of computers and other things, where the CFD coming in, I think that was about 1994. So the CFD was 1994, and it was, I've already explained to you what the CFD is with the leverage. So that one, you don't earn dividends, but you can buy and make profit based on the change in price. So I think we're going to come back, we're going to take a break, but when we come back, we're going to be looking at some charts. We shall also be talking about more of this, and we'll look at some charts and do what I normally do on Trading Dawn. Look at some Forex charts, the economic calendar, and then we move on from there. So let's take a quick break right now.